Good evening, everyone. Good evening, Sudhanshu. Good evening, Bhumika, Darshan, Himanshu, Sundar. I hope you guys are doing well, enjoying CA inter studies, right? Uh, Let us quickly recap the ratios that we have done till now, and then I'll take you towards the next set of ratios. Okay. So, ratio-wise, we have stated that we are going to have uh, broadly four categories of ratios. One is about the liquidity, then next is about the leverage, then it is activity, and then the profitability. We've seen current ratio as a ratio, which is a ratio between current asset to current liabilities. Okay. And of course, we said that current ratio, a higher current ratio indicates greater liquidity. But if your current ratio is really very high, then it is actually indicating some sort of inefficiency. Because if you have high current ratio, you may be having higher stock or higher debtors or higher cash and bank balance. And accordingly, if you have a higher stock, there will be selling inefficiency, higher debtors means collection inefficiency, and high amount of cash and bank balance means you are not able to identify, good investing opportunities, right? Okay. So next we said that ideal current ratio should be 2:1. Then there is another strict ratio which talks about a greater liquidity sense. That's your quick ratio, which is quick asset upon current liabilities. And what all is included in quick assets? In that you have the current asset, but from that you reduce your inventory and the prepaid expenses. Okay. So current asset, less inventory, less prepaid expenses, or in a sense, we're talking of cash, bank, short-term investment, and debtors. Okay. So ideal quick ratio is going to be 1:1, right? Cash ratio or absolute liquid ratio is the most strict version of it, which is cash, bank, and short-term investment, the whole divided by the current liability. So ideal cash ratio is 1:1. Now, does the company have sufficient quick assets to meet day-to-day? For that, we check the defense interval ratio, which is basic defense interval ratio, which is simply quick assets upon operating expenses per day. And we know that basic defense interval gives you answer in number of days as to how much number of days can you survive with the available quick assets, right? So how much days operating expense you can meet with the help of quick assets. Then some of the long-term solvency ratios that we saw was debt equity ratio, which is debt upon own funds. Debt ratio, we had total debt upon net assets, which is fixed asset plus current asset minus current liability. Equity ratio is basically shareholders' funds upon the net assets. Then we had this capital gearing ratio, in which we considered in the numerator all those funds which require a fixed rate of return, which was borrowed funds and preferential capital. And in the denominator, you had equity shareholders fund. Now, in this case, debt ratio, debt equity or equity ratio, we have seen that if each of those ratios are higher, what does that mean? What does that mean with respect to solvency and risk? Long-term solvency should also consider ability to pay dues on time. So that's your X, Y, and Z. Let's say three persons, and we said that how many times their EMI, how many times of EMI is their income, and similarly we have this coverage ratio. So in the coverage ratio, first one was how capable you were to pay interest. So for that, EBIT upon interest, how capable you are to pay your preference dividend, that's PAT upon preference dividend. Fixed charges coverage ratio is EBIT plus depreciation. And we consider what is your total due, that is interest plus the principal repayment. Debt service coverage ratio is earnings which is available for debt service upon interest plus principal repayment. So earnings which are available for debt service, it's simply your interest plus principal repayment. Okay. Now earnings available for debt service, for that we have PAT plus non-cash expenses plus interest, and we also add or subtract the non-operating items. Then we were looking at the activity ratios, which were all in the form of sales or COGS divided by the respective number, which is like assets, fixed assets, net assets, current assets, or the working capital. Inventory or stock turnover ratio is COGS upon the average stock, which was actually indicating us how many times of the stock is your COGS. That's basically 4 times from the example that we get. And similarly, we had a inventory turnover as an indication that higher efficiency in selling. Then inventory holding period or stock holding period, it was 12 months upon stock turnover, which was 3 months, which is like it is telling us in how many months one lot of stock would be sold. So high activity means high turnover ratio, and of course that means low inventory holding period. Similarly, we had the receivables turnover and also the creditors turnover or payables turnover. So we have done these ratios till now. We'll take up the next set of ratios in our discussion now. But before that, let me see if there are any queries. I had a query from previously. I had a problem in solving debt ratio and equity ratio. My answer is not getting varied from us. Can you please explain? Answer is not getting varied. Debt ratio is long-term debt upon total assets. Over here. Yeah. Debt ratio is basically debt upon the net assets. Right. And I think we have taken this number. Yeah. So total assets or the net assets is going to be this figure. That's the total capital employed itself will be the asset side, right? Balance sheet, asset and liability should match. So for that case, you had the debt ratio as debt upon net assets and equity ratio will be equity upon net assets. Sir, does net assets exclude both current and non-current liabilities? Net assets is your fixed asset plus current assets minus current liabilities. Okay. Then I had a query from previous class that is done. What are the considerations for procuring funds? Consideration for procuring funds is basically the cost that you need to pay. Isn't all turnover ratio, sales or COGS upon average respective heads? Yes, Ms. Boma, you're true. Average accounts receivable and average accounts payable are computed as opening plus closing divided by 2, which is the average of opening and closing figure. Okay, fine. Now let's go for the next set of ratios. So in the first half of our session, we will be going through the ratios, the pending ratios, and probably in the next half, we'll do some practical questions from the module, right? And if possible, also some from the past papers or MTP and RTP things also. Net assets exclude depreciation. Of course, net assets is computed as net fixed asset, that is gross fixed asset minus depreciation. Ruchi is saying which one? Over here. In case of your answer, 0.2 in case of debt ratio. Debt ratio, it is 0.2. Yeah. And 1 second, what it is? Okay, borrowed funds is 8 lakh. True. So though both of them are correct, they will get replaced. So equity ratio is 0.2 and debt is 0.8. Correct. Correct, so you're right. Can we calculate propriety ratio for checking long-term solvency position of business? Correct. Yes, you can, Bhumika, sorry. Fine. Let's go for the next set of some of the interesting ratios now. Next ratio that we have is the profitability ratios. So we are simply talking of how to check if the company is generating adequate profits. So how are we going to check whether a company is really generating adequate profits? The answer is we need to calculate profitability ratio. Right? So profitability ratio, we have got 4 important profitability ratios or 4 categories basically. First is the profitability ratio which are based on sales. Second is based on return on investments. Based on return on investments. Third is based on return to owners. And then last is based on market. Based on market, or we're talking of the investors. Okay. Now, let's first talk of the initial part, which is based on sales. The first part that we're talking of is based on sales. Okay. So based on sales, first ratio that we are talking is gross profit ratio. Gross profit ratio. So over here, based on sales is simply gross profit ratio. Now, gross profit ratio will be the gross profit upon sales into 100. It simply tells you what percentage of your sales are you generating gross profit. Similar to this, we have the net profit ratio. Net profit ratio is simply the profit after tax upon sales into 100. So it is telling you what percentage of your sales is the net profit. Then operating profit ratio. We have this operating profit ratio. Operating profit ratio is EBIT upon sales into 100. Right. So remember, we're talking of EBIT, which is whenever you say the term operating profit, that's going to be your EBIT. Right. So now, how do you compute this EBIT, by the way? This EBIT figure, since it's an operating profit, that's actually computed as sales. From that, you reduce your COGS, right? Now, sales minus COGS, this gives you the gross profit. Now, from gross profit, you further subtract your operating expenses. Now, what all things do we have in operating expenses? So in operating expense, we have admin, selling and distribution expenses. So all your administration, office admin cost and selling and distribution expenses, those are your operating expenses, and that needs to be subtracted to obtain the EBIT figure. Okay. Fine. Now there are certain ratios which are expense ratios. There are certain ratios which are expense ratio, and those expense ratios are like, first it is COGS ratio. COGS ratio is simply COGS upon sales into 100. So what percentage of your sales is COGS? That is what this expense ratio is going to tell us. And also you can say this is same as 100% minus gross profit ratio. 100% minus gross profit ratio. EBIT means earnings before interest and taxes. Shubham, EBIT means earnings before interest and taxes. Okay. So before subtracting your interest and taxes, whatever is left, that's your EBIT. So COGS ratio 10. Operating ratio. Operating ratio. Operating ratio is COGS plus operating expenses upon sales into 100. COGS plus operating expenses upon sales into 100. That's your operating ratio. Then we have the operating expense ratio, only operating expense ratio. Only operating expense ratio. So that's your operating expense upon sales into 100. Right? Operating ratio is operating expense upon sales into 100. And then we have the finance expense ratio. Whatever is the finance expense. So all your ratios are like this one is finance expense upon sales into 100. Correct. So these are your based on sales profitability ratios. Right. Just go through them. I'll just give you half a minute. Are we good, guys? Fine. So let's go for the next set of ratios, which is now based on this portion, that is return on investment. So return on investment, which tells you about how much return the company is generating for which type of investor. So let us talk about something called as based on return on investment. Now, based on return on investment, we say that how to compute the return on investment. Return on investment is simply what you get return on investment, right? Whatever amount you have invested, that goes into the denominator, and whatever income you earn from that, that's your return. Correct? So this is a simple fundamental return on investment. Now to understand in more detail what type of returns are we talking of, let's look at a income statement. Okay. Now, income statement, it begins with the term of sales. So sales, from that we will subtract all your operating expenses. Now, what all things are included in operating expenses? What all things are included in the operating expenses, guys? This includes the COGS and also the operating expenses, which is like your admin costs and selling and distribution expenses. Okay. So COGS plus admin plus selling and distribution expenses. Now, yeah. So from after you subtract operating expense from the sales, what you get is earnings before interest and tax. Earnings before interest and tax. And from that, you will subtract the interest component. What we get is profit before tax. Right? So we get the amount of profit before tax. From that, we subtract the taxes. And then the balancing figure is profit after tax. The profit after tax is still not a income for all the shareholders. Rather, it is less preference dividend. And once you subtract the preference dividend, we have the net profit for equity shareholder. Net profit for equity shareholder. So this is the typical income statement that we have. Okay. Now you understand that this portion, that is from sales till EBIT, it is all operating. From sales till EBIT, it is all operating. And then after that, from EBIT till net profit for equity shareholders, it is financing. The first portion is operating, and the second portion is that financing. Now, this financing part is going to get affecting how much you are paying interest, how much preference dividend you are paying, right? Understand that this particular number, EBIT, this is income for all. This is income for all. So EBIT as a figure, this is the income which is available for all, for equity shareholders, for debenture holders, for preference shareholders, right? Can you tell me this profit after tax? This one is income for whom? Profit after tax is income for whom? Profit after tax. Whom does this income belong to? Profit after tax. PAT. Is it an income for all the stakeholders? Is it income for all debenture holders, for all preference shareholders, for all equity shareholders? No. This is income for owners, right? And remember, owners means equity shareholders plus preference shareholders. And what about net profit for equity shareholders? The net profit for equity shareholders is income for equity shareholders only. Income for equity shareholders only, right? So when we are talking of this ratio of return on investment, and talking of this ratio, set of ratios of return on investment, we have three categories, broadly three categories to understand what is the return on investment as a number. right? Now, return on investment as a number, we have something on assets. Then you have on capital employed. And then on equity shareholders funds. On assets, see, the company has assets, some amount of assets, and by employing those assets, company is generating some revenue. Company is generating some revenue, company is generating some profits, right? So when we say on assets, there are multiple ways of stating the ratio. One method is to look for PAT upon total assets. Second is EBIT 1 minus T upon total assets. And then you have EBIT into 1 minus T upon net assets. Now, what's the difference between this? See, if the question says you it's a after tax return on total assets, after tax return on total assets, you will take it as a PAT upon total assets. Then, when we have return on total assets, you say this after tax return on total asset, which is only based on EBIT. And when we say this is return on net assets. So this one is return on total assets, and this one is return on net assets. Now the question is definitely going to specify as to which ratio are they talking of, whether they're talking of return on total assets or net assets, or you have to take PAT as a figure that will be specified. Okay, but ideally, if you ask me personally, sir, which is a more correct one, that's technically this last ratio, which is return on net assets. Whatever net assets you have, we know that net assets, what does this net assets indicate? It indicates fixed asset plus current asset minus current liability. Fixed asset plus current asset minus current liability. That's your net assets, right? So this is the capital employed. On this, you are earning your earnings before interest and tax. So 1 minus T, T is the tax rate. T stands for the tax rate, which is telling you 1 minus T makes it as a technically a after tax rate of return, right? So for example, if 100 is your income and on that you pay 30 as tax, 70 is your net income, right? So this 70 is denoted by EBIT 1 minus T. So T is the tax rate. So for example, if your EBIT is 1000 and your tax rate is 30%. So sir, EBIT into 1 minus T will be 1000 into 1 minus 0.3, which is 700 will be EBIT 1 minus T. So T stands for tax rate. Okay, I hope this is clear to you guys. Now, on capital employed, what are the return on investment ratios? On capital employed, you have got two portions. One is pre-tax and other is a post-tax. Pre-tax and a post-tax. So on capital employed, we have pre-tax and post-tax. First, let's talk of the pre-tax return. Now, capital employed. Capital employed means all the fund providers, which is basically equity shareholders fund plus preference shareholders fund plus debt funds or borrowed funds. So when you include all three of them, equity shareholders plus preference shareholder plus debt funds, combined all three of them, that's your total employed. So we know that EBIT is the number, EBIT is the income which is generated for all the shareholders. And for that reason, we have over here the pre-tax return on capital employed as EBIT upon capital employed. Or you can say this is EBIT upon owned funds plus borrowed funds. Right? So EBIT upon owned funds plus borrowed funds. So pre-tax return on capital employed is EBIT upon capital employed, or you can say that capital employed is owned funds plus borrowed funds. Now, when you want to make it as a post-tax, you can simply say, sir, that this is EBIT 1 minus T upon capital employed, or you can say this is EBIT 1 minus T upon owned funds plus borrowed funds, right? Correct, right? So that's your return on capital employed as to how much return you're generating on the capital employed. Then on equity shareholders fund, we have the ratio which is stated as return on equity. Now return on equity will be simply what is the return that we're generating for equity, sir? It's net profit for equity shareholders, right? So this is net profit for equity shareholders divided by equity share capital plus reserves minus any fictitious assets. We know what is fictitious assets, the P&L debit balance, miscellaneous expenditure not written off, all those assets which are technically not assets. Okay. So whenever we talk of return on investment, these are the possible things that what return is the company generating for its stakeholders, be it all the shareholders, be it all the preference shareholders, be it debenture holders, or be it the entire company, right? Correct. So whenever it is capital employed, remember we are talking of all the fund providers. So what are we going to give to all the fund providers? It's the EBIT, right? Because from EBIT we are going to pay interest. From that we are going to pay taxes. From that we are going to pay dividend to our equity shareholders. From that we are going to pay dividend to our the preference shareholders. So EBIT is something which is earned for all your stakeholders, and therefore when you say on capital employed, you have the EBIT as a numerator. And in denominator, of course, the amount of capital employed. Okay. I hope these ratios are quite intuitive enough to understand. It's following the simple rule of return on investment. Whatever return you have, whatever income is being generated, divided by the amount of investments. Okay. So I just give you a minute's time to go through these ratios once so that we can then go for the next set of ratios for our discussion. Please go through the ratios. Go to the ratios once, guys. Yeah. Look at these ratios. Try to grasp it as properly and easily possible. Understood? Fine. Then we can go for next set of ratios, which is set of market ratios. One second. Dividend is income. Operating financial, those are items or expenses. Dividend income is a financing income, so it's not your operating income. Okay. Let's look at the market ratios now. market ratios. In case of market ratios, the first ratio that we have is earnings per share. So as the name says, earnings per share, it is net profit for equity shareholders upon number of equity shares. Simple. So let's say the company has net profit for equity shareholders as 10 lakh. Number of equity shares is 1 lakh. And let's say the company has paid a dividend of 4 lakh. Now, using all these numbers, we are going to calculate a number of ratios. Now, earnings per share. Per share, what is the income that the company is generating? That's basically 10 lakh upon 1 lakh, which amounts to 10 rupee. 10 rupee is the earnings per share. Now, if I ask you what's the dividend per share, how much the company is paying dividend? So that will be like total. Remember here we are talking of equity dividend. So total equity dividend upon number of equity shares. So which is like 4 lakh divided by 1 lakh. That amounts to just 4 rupees. Now, if I ask you out of its earnings, what proportion has company paid out as dividend? What is the proportion of the earnings of company which company has paid out as dividend? What percentage of income is paid out as dividend? It is the dividend payout ratio. Right? So dividend payout will say we are paying dividend per share on some earnings per share. So earnings per share divided by, or I can say dividend per share divided by earnings per share. So dividend per share is 4 rupee upon earnings per share is 10, which is 40%. Correct? If the company is paying out 40%, how much percentage is the company retaining? That's the next ratio, which we call it as retention ratio. Now, retention ratio is simply from the earnings, the company has paid some dividend upon the earnings. So basically, out of 10 rupee, company has paid out 4 rupee divided by 10 rupee, which is 60%, right? You can also say that retention ratio is 1 minus dividend payout ratio also, right? So that's your retention ratio. Simple. These ratios are very simple. The next ratio is about how much yield the company is providing in the form of dividend, right? Yes, Shubham, you're right. You can also take total dividend to net profit for the dividend payout. That is total dividend to total net profit. That also you can do. Now, dividend yield. Now, what's dividend yield? Let's say over here, as we said, the company is having a dividend per share of 4 rupee, and the same company market price of each share in the stock exchange, it is observed that it is, let's say rupees 20. So market price when it is 20 and company is paying out dividend of 4 rupee. Can you tell me what's the dividend yield that the company is having? The dividend yield is 4 upon 20, which is 20%. Right? So 20% is the dividend yield. And similarly, if I ask you, what is the earnings yield? Earnings yield is like, company is having per share earning of 10 rupee. And of course, the market price is rupees 20. Then this earnings yield is 10 by 20, which is 50%. Right? So earnings yield is what percentage the company is providing to its, what percentage return the company is providing to its shareholders. in the form of dividend or in the form of yield. So company has earned 50% on the market price, and over here company is paying dividend of 20% on market price. Okay, retention. Who's this? Mahesh. Yeah, Mr. Mahesh is asking what is retention. Retention means, Mahesh, it means what the company is retaining with itself. Like, for example, out of 10 lakh, the company paid out as dividends. The company has paid out 4 lakh as dividends. It means company has actually retained with itself, or it has kept with itself 4 lakh, right? So that's kept with itself 6 lakh. Company has paid out 4 lakh. So it has retained 6 lakh. Or you can say per share company is having 10 rupees earnings, out of which it is paying out 4 rupee as dividend. So they are basically retaining that balance 6 rupee, and that 6 rupee is the 60%. Yield means return, Himanshu. Himanshu, yield means what sort of return you are getting when you take market price as your investment, right? So Goma is asking, when we talk of return on investment, from whose perspective is it? Is it the investor who is investing in the company, or the owners of the company who have the investment outside? When you say return on investment, whoever have put in the investment, what return they are getting from the company. Simple. Wherever you put your investment, you see that what return are you getting from the company, right? That's your return on investment. Whether you put it in a company, in a bank FD, or in some real estate or some mutual fund, it's the person who makes the investment is more interested in the return on investment. True. Okay, now let's look at the next ratio. The next ratio, which is PE ratio. Price to earnings ratio. What is market? Ustad Singh, market is MPS is market price per share. Sanjit is asking what's difference between EPS and DPS. Sanjit, EPS is what the company has earned for each shareholder. DPS is what the company has paid out as dividend. I hope you understand difference between earnings and the dividend of the company. Earnings is what the company has earned. Whatever it has earned, it did not pay it out to the shareholders, right? So whatever it is being paid out as shareholders, paid out to the shareholders in the form of dividend, that's your dividend per share. Okay, let's come back to this ratio of price to earning ratio, or with love we call it as PE ratio. PE ratio. Okay. Now, as the name says, the PE ratio stands as market price per share upon earnings per share. It tells you, it simply tells you how many times of EPS is NPS. How many times of EPS is MPS? So let us say there are two companies, X and Y. Both of them are having a same earning of 10 rupees, but they have different market price. X has got a market price of 50, Y has got a market price of 80. And according to you, over here, if we compute the P ratio, which is market price to EPS, here we have it as 5 and here we have it as 8. And this is always measured in times, by the way, guys. Okay. Always remember it's going to be measured in times. So if it is in times, and if you look at this for the same level of earnings, Y is having a market price of 80. For same level of earnings per share, Y is having a market price of 80. And well, X is having just a market price of 50. So according to you, which company enjoys a greater investors' confidence? Out of X and Y, which company enjoys a greater investors' confidence? Tell me. What do you feel? Which company is having a greater investors' confidence? Is it X or is it Y? Is it X or is it Y? Yeah. Do you feel which company enjoys a greater investor confidence? Is it X or Y? Okay, majority of you are saying Y. True, correct. So yes, we can say it is the company Y, which is having a greater investors confidence. It is company Y, which is having a greater investors confidence. So that is 8 times, right? Right, because it is 8 times. Because see, for the same level of earnings, the company has got uh, a higher market price. Now people are ready to pay a higher price for this company because it has got a confidence of the investors. Like I'll tell you a simple example. You have Apple and you have MI. Both of them offer you the same set of features, right? They offer you the same 15 megapixel camera or 50 megapixel camera, 4 GB of RAM or 6 GB of RAM, 128 GB storage, processing speed is same, everything is same, almost on the same lines. Both of them are having the same set of features. But we know that Apple phone is going to cost you somewhere like, let's say 90,000. MI is going to cost you with the same configuration around 30,000, 30 or 40 or 50,000 maybe max for that case. Now, people are ready to pay more for Apple products, right? So for the same set of feature, the buyers or the customers have more reliance on Apple and therefore they're ready to pay more for it. Whereas for X and Y, you can see on the similar lines, similar EPS, same EPS for both the companies X and Y, same companies, same EPS for both the companies, but then the market price per share is different, and for Y it is 80. For Y it is 80, and it means for the same EPS, people are ready to pay more because they have a greater confidence on the future of the company. Okay, perfect. Great. That's your price to earning ratio. So higher the price to earning ratio, it indicates higher confidence of investors, right? Assuming that markets are efficient, it should not be the case that market price is, artificially inflated. If it's artificially inflated, then you cannot say that the company has got a greater confidence, right? Okay, let's go for two more pending ratios. One is called as market value to book value ratio. Market value to book value ratio. So, which is simply market price per share upon book value per share. Now, how do you get this book value? Let's say we're talking of a balance sheet. In the balance sheet, the company has got some assets. Let's say the company is having assets worth 100 crores. Company is having equity share capital of, let's say, 20 crores. Right? And then the company is having some sort of reserves and surplus of maybe, let's say, 60 crores. And then you have a debt of 20 crores. Right? So if I ask you, what is the net worth of the company? Net worth means what is the worth of this company for the equity shareholders? Net worth of the company is obviously whatever the equity shares that the company is having and the reserves and surplus, right? So you can say it is like 20 plus 60, which is 80. Or you can also say assets minus outside liabilities. So when you say outside liability, that's like 100 minus 20, which is 80. So 80 crores is the value. This 80 crores is the value of all equity shares, right? So if I ask you what is value, or this is basically the book value, right? I'm not talking about the market value. In the books of accounts, all the equity shares are having a value of 80. So similarly, if I ask you what is the book value of each share, book value of each share. The book value of each share is 80 divided by the number of shares. Let's say we say 20 per share, 10 rupee. So 2 crores. 80 crore is the book value of all shares, and we have 2 crore shares. So in total, you get rupees 40 as book value per share, right? So book value per share comes out to be 40, which means that each of the share that the company has issued, as per books of accounts, it is having a value of 40 rupees. Whereas you observe that in market, the same share is being traded at 60 rupees, right? So if we look at the ratio of market price per share to book value per share, that's 60 by 40, which is 1.5 times. So basically, market value to book value share, it indicates how much is the market value of the company, how much is the market value of the company as compared to its book value. So as compared to its book value of 40, the market price is 60. So 60 by 40, that's 1.5 times. And of course, when this ratio is higher, it means it enjoys a sort of greater confidence amongst equity shareholders, because equity shareholders are ready to pay a higher market price over and above what the book value of the share is. Higher market price over and above what the book value of the share is, right? Perfect. So that's your ratio. The next ratio, which was market value to book value ratio. Okay. The last ratio in the series that we have is something called as Q ratio. Now, Q ratio is simply market value of company, right? Market value of company divided by Q ratio is you're taking the market value of the entire company as a whole, and you divide it by not the book value, but you divide it by replacement cost of assets, right? So both the earlier ratios that we had, PE ratio and this indicates the investor confidence. So if your market price to book value per share is, this ratio, if it is lower, it indicates it enjoys lesser investor confidence, right? You need not conclude that it is undervalued. You need to go into depth. What is the company's industry? What sort of industry the company is into? What business it does? What products does it sell? What profitability it has? So you need to check out a lot of other factors also. But yes, a higher number indicates a higher confidence. Now coming to this Q ratio, market value of the company divided by the replacement cost of assets. So here we have this assets. So let's say company has got land and building, company has got the machinery, company has got the furniture, company has got some sort of current assets. Okay, and it has got some current liabilities also. So let's say land and building is 100 crores, machinery is having a value of, let's say, 60 crores, furniture is having a value of 40, current assets to the tune of 50, and current liability is 10, right? So when we are looking at over here, these all are your book values. But when I want to compute the Q ratio, I need the market value of the company. So let's say market value of the company, which is market value of all the shares basically. So market value of the company is, let's say, approx 500 crores. All the shares of the company that are being traded, that are worth, let's say, 500 crores. And each of these assets, let us assign some replacement cost. That is, we want to know what is the cost of replacing these assets as of now. So let's say a similar land and building, if I need to purchase now, I need to pay, let's say 120 for that. A similar machinery, if I want to purchase now, I need to pay 40 for that. A similar furniture, if I need to have, I need to pay 30. And for current assets, you can say a similar current asset, which is a stock, cash and debtors and short-term investments. The current replacement value is, let's say 60, and this current liability is, let's say 50. So if I say replacement cost of assets, that's basically 120 plus 40 plus 30 plus 60 minus 15. So this all adds up to how much? 120 plus 40 plus 30 plus 60 minus 15. So that's 235, right? So what will be the Q ratio over here, guys? What will be the Q ratio? So Q ratio will be 500 divided by 235. 500 divided by 235, which is 2.13, right? So this means the market value of the company is 2.13 times of replacement value of the assets that it has. It means market value is more than the current replacement value of the asset. Currently, if you want to buy similar assets, you need to pay less. The market value is higher. Market value of the share is basically higher. Okay, so this indicates sort of overvaluation, right? Higher these ratios, some sort of they indicates overvaluation. Yes, we are taking net assets. Replacement cost of assets means I'm just taking the market value of the company. So when I say market value of the company, it's the value of all the funds, that is equity shareholders and debenture holders. So of course, we're talking of the net assets. Unless and until specified, we are always going to talk of net assets. Okay. I hope these ratios are clear to you. The P ratio, market value to book value, and then we have this Q ratio. Okay. Q ratio. This ratio was actually developed by a person, Mr. Tobin, who named it as Q. Now, there's no reason why it is Q. So it's the ratio which has been given by him. Just like, you don't know why the thing is called as a mean, arithmetic mean or geometric mean, or why do we call that as a standard deviation? Why do we take it as a sigma? Same way, it's just a standard notation which has been provided by Mr. Tobin. Right, so Mr. Tobin was the one who has developed this ratio for analysis purpose. Okay, the last conceptual part that we have from this chapter. So we'll do that right now, and then we'll take a break, and then after that we'll begin with the questions. The last part is talking of Dupont analysis. Dupont analysis. Now, tell me, return on equity, we know it is profit after tax upon equity shareholders fund. Now, this same return on equity, let's say there are two companies, A and B. They are having a return on equity of 20%. They're having a return on equity of 20%. A and B, both are having a return on equity of 20%. How do I actually analyze further as to, which company is better in which aspect? So for that, what Dupont analysis does is it actually breaks this ratio into three parts. One is the profitability ratio. Second is the turnover ratio. And third is the equity multiplier ratio. Profitability ratio, turnover ratio, and equity multiplier. Now, we can actually break this return on equity into three another ratios. When it comes to profitability, that is PAT upon sales into the turnover is like the asset turnover, sales upon total assets. Then the equity multiplier is assets upon equity shareholders fund. So just looking at 20% is not going to be sufficient for our analysis. I need to look into how this 20% has been arrived at. So let's say for company A, it was 20%. I'll look into the further breakup of these three components of it. Profitability wise, the company is having a profitability percentage of, let's say, 10%, or maybe let's say 5%, 2 times asset turnover, and equity multiplier is also 2 times, right? And then you have this another company B with the same return on equity as 20%, but right now the company is having a profitability of 10%. Company is having a profitability of 10%, turnover of let's say 1.5 times, right? And then we have this is, let's say, 1.33 times. Okay, so if I compare both companies' performance, the company A is having a 5% profitability, that is, as a percentage of sales, A is actually having a less margin. A margin is thin for A, whereas margin is substantially better for B. For B, the margin is 10%. But you know what? A is actually utilizing this lower margin by having a greater turnover. It means over here, it is able to use its assets to generate double its value as sales. And this uses, this is 1.5 times, right? So this is 1.5 times of the assets. So B is having B is having a turnover which is 1.5 times of its assets. Equity multiplier is 2 times and 1.33, which means this company A is again having a asset level which is double of equity shareholders. When you say double of equity shareholders, it means it is having some sort of debt, right? If your assets to equity shareholders fund is 2 times, it means asset is 1 and equity is 1. It means there is some one which is having a debt. So that's your 2 times. So equity multiplier is, when you say it is 2 times, that's asset to equity shareholders funds. And here it is lower. So gearing wise, this is like gearing we can talk of. For company A, margin is lower, turnover or activity is higher, and gearing is also higher. But in this case, we'll say that margin is higher, turnover is lower, and gearing is also lower. Correct? So margin, turnover, and gearing. These three are the parameters which are actually influencing the profitability. Now, if I would be a advisor for company B, I would strongly recommend them to improve these ratios. Go for higher gearing because your margins are good. For every unit of sale that you're making, you're good. You're having a good amount of profit. You're having a good percentage of profit. So if I'm advisor to this, I will recommend that you increase your turnover, increase your sales by some sort of incentive, by some sort of advertising or whatever, and try to take more gearing. That is, try to invest more funds by, if possible, taking a loan also. Right. So that's your Dupont analysis, which actually tells you how to differentiate a similar return companies on three different criterias. One is on the profit margin, second is on the activity or turnover ratio, and third is on the basis of the equity multiplier, or which is the gearing ratio. Okay, that's your Dupont ratio, uh, which is for in-depth analysis of the numbers. Now let's do one thing. Let's take a break of 10 minutes, guys. After that, we'll begin with the questions from the module, and wherever required, we'll take it from the from the past question papers or RTP or MTP, wherever it is possible. Okay, so let's take a break now of 10 minutes, guys. So welcome back, guys, after the break. Let me see if there are any queries, or else we can go for some questions to be solved. Why is it not what? But sir, which company is doing better ultimately? Good or bad, it depends on the perspective wise. Good, it may be in terms of liquidity, in terms of profitability, in terms of stability. So that perspective needs to be defined. Darshan is asking if P and market value to book valuations are lower, does that mean the company is undervalued? Yes, you can say, but you need to check whether it is really undervalued or whether it is actually having lesser value. Okay, for that, you need to check the company's profitability, future prospects, what business is it into, what projects is the company undertaking, and so on and so forth. Okay, so let's now go ahead with some interesting questions. The first set of questions that we would be discussing is, just analyzing the very first part is how to compute the ratios and how to analyze them. Okay, so let me just put it together. Yeah. So if you look at the first question, they have given us the income statement for 1920 and 2021. And based on that, they have asked us to calculate certain ratios. Okay. So I want you guys to look at the question. Okay. And try to calculate these ratios. Try to calculate these ratios based on the numbers. I hope you have the module with you. So I'll just give you, to compute these ratios. I'll just give you possibly, how many ratios do we have? 7, right? So for 7 ratios, should get around 3.5 minutes. Just do the calculation in rough and see if you are able to match the numbers, right? Please open up the module and try to solve it from the module itself. Or else I'll just do one thing. I'll add up a page over here so that the question comes opposite to each other. Yeah. So here we have a question. You can access the module. The first question, it's a task for you to compute the ratios by simply using the ratios that we have learned right now. It's 728 till 733, max to max, 5 minutes. Within 5 minutes, get these ratios roughly calculated, guys. Get these ratios calculated roughly and let me know if in any ratio you're finding any issue or any problem in the calculation. Okay, try to calculate the ratios, guys. Calculate these 7 ratios. I'm giving you time of 5 minutes. Try to calculate it on your own and verify the numbers. And then we'll analyze them. Whether we have to compute for both the years, 1920 as well as 2021. Yeah, I hope You're doing the calculations, guys. 3 minutes left, quick. Two minutes left. Darshan is asking, should we take sales or COGS for activity ratio? Ideally, you should take sales, unless and until it's something like, inventory turnover or stock turnover. For that, you take COGS. Otherwise, you should take sales. Couple of minutes left, guys. Do the ratio calculations quickly. I hope you're able to get the numbers. Yep. We have just 1 more minute left. Hurry up, guys. Just few seconds left. Okay, time up, guys. Are we all done? Have we all completed the ratio calculations? How many of you are done? Please let me know. Have we computed the ratios? Or how many ratios are yet to be done by you? Okay. So whenever ratio you're calculating, whenever you need averages, if information is given, you can take average. If no such information is given, then you can take the closing balance also. So for example, let's say you're required to calculate the following ratios for the year 1920. And in 2021. So we need the gross profit ratio. Now for gross profit ratio, we need the gross profit, which is there. And this gross profit will be divided by the sales amount, right? The sales amount. So 64,000 divided by 3 lakh, and this is 76,000 divided by 3 lakh 74,000. That's your gross profit ratio. Simple. Operating expense to sales ratio. So you have your operating expense as 49 and 57,000. So 49,000 divided by 3 lakh, 57,000 divided by 3 lakh 74,000. That's your operating expense to sales ratio. Then you have the operating profit ratio. Operating profit is simply going to be your gross profit minus your operating expenses. So you have the gross profit minus operating expense already calculated 15 and 19,000. So 15,000 and 19,000. Then capital turnover. So for capital turnover, we need the sales figure divided by the capital amount. So capital amount is given up over here. See. So capital is like 1 lakh and 1,47,000. So 1 lakh and 1,47,000, and turnover, we are going to take the sales 3 lakh and 3,74,000. So 3 lakh divided by the capital, 374 divided by the capital, that's the capital turnover. Then we have the stock turnover ratio. Now stock turnover ratio is basically COGS divided by the average stock, right? The COGS divided by the average stock. So capital, since it is stock turnover, we have the COGS figure, and average stock. For that, the information we have in the question, see the stock is given as 60 and 94,000. So opening stock of 40,000 for 1920. So opening stock over here, it was 40,000. So average stock will be 40 plus 60,000 divided by 2, which is 50,000. Right. So average stock is 50,000 over here. And similarly, for the next year, it is average of 60 and 94. So 60 and 94 average, that works out to be 77,000. You compute the stock turnover accordingly. Net profit to net worth. Net profit, it is this. Net worth is what your share capital and reserves and surpluses or owned funds basically. So net worth is net profit upon owned funds. Right. So this is 75,000, and over here 75 and 42, which is 117. Net profit to net worth ratio. Receivables collection. These are the receivables value, and collection is based on the sales. So that is sales divided by average receivable. Now we don't have average for average. We don't have the opening of 1920. So when there's opening 20, when we don't have the receivables in that case, the receivables turnover is going to be what do we need? Receivables collection period. My bad. So receivables collection period is going to be average. This is simply receivables collection is this can be computed. I'll just compute it in a bit different way. Receivables turnover. This is your sales, which is 3 lakh, and divided by the receivables amount is 50,000. 50,000 and 80,000 is the receivables amount. Now, of course, I cannot take 3 lakh fully for receivables because 30,000 is cash sales, right? So what I'll do is I'll take 2,70,000, which is the credit sales, divided by your receivables amount, which is 50,000. So 2,70,000 divided by 50. 2,70,000 divided by 50,000, which is 5.4 times, right? Now, if I want the collection period, I simply take it as 365 divided by 5.4. So 365 divided by 5.4, that amounts to 67.59 days. or 67.6 days. Similarly, you can get this 87.5 days. Now, our idea is not to just compute these ratios, but also to provide some insights from these percentages, some analysis from these percentages. So you can observe that gross profit ratio, it has reduced from 21.3% to 20.3%. So there's a minor reduction of 1%. Operating expense ratio has also fallen, but there's an increase in the operating profit. So even though GP has reduced, there is some savings that happening in the operating expense, and for that reason, operating profit has also marginally improved. Capital turnover ratio has marginally reduced. It means you're not able to utilize your funds, or not able to, actively use your funds properly. Stock turnover ratio has also reduced. It means some of the stocks are not selling as fast as they should be. Net profit ratio has improved. Receivables collection has also increased. It means you're not able to collect from the debtors on time, right? So all those things you can say are some of the highlights that's given in the solution also. There's a corresponding increase in the receivables also due to such credit policy. So receivables collection period has increased because you are more liberal in giving credit to your customers. Okay, now let's go ahead and do some questions, where we are essentially required to prepare a trading and P&L account. I'll do a question from practical problem. Let's say practical problem number which one? Balance sheet and P&L where it's required. Let me just help it out. Yeah, let's just try to solve this question, which is question number 4, practical question number 4. I'll try to solve it on the normal page that we do. Let's solve it, and if that's good, if this gets done and we have more time, we'll take up some question from past RTP or MTP for that case. Okay, so here we have the question. Let's begin, guys. So Ganpati Limited has furnished the following ratios and information relating to the year ended 31st March 2021. Sales is 60 lakh, return on net worth is 25%. Return on net worth is 25%. And we have the rate of income tax as 50%. Capital to reserves is 7:3. Current ratio they're maintaining is 2. Net profit to sales is 6.25. Inventory turnover based on COGS is 12. See, here the information is given that it is based on cost of goods sold. Cost of goods sold is given, interest on debentures amount is given, receivables amount is given, payables amount is given. We are required to calculate the operating expenses and prepare the balance sheet. Anyways, so let's prepare the balance sheet first, and then we can try to, fill up the things. Let me just have the balance sheet format which they have already given to us. Okay, so whatever information we have, let's just try to punch in the balance sheet, and whatever ratios we need, we can calculate it later. So first up, we have the value of receivables, we have the value of payables. So let us just enter the values. The receivables are 2 lakh. Payables are also 2 lakh. Right. Then we have the interest on debentures, cost of goods sold, sales is given, rate of income tax is given, net profit to sales is also given. So a lot of things are given. Let's try to just work around certain things. Like first up, let's use this ratio of inventory turnover. Look at this inventory turnover. Inventory turnover is given as 12, which is based on COGS, guys. So inventory turnover is based on COGS. So when you're looking at COGS, we're talking of COGS upon, we actually need to take the average inventory. But the thing is, we don't have average inventory in our books. We have just the closing inventory. So we'll take the normal inventory, which is 12 equal to COGS is 18 lakhs divided by inventory of 12. So inventory is something we need to compute. So we have the inventory value 18 lakh divided by 12. 18 divided by 12, which is 1.5 lakhs or 1 lakh 50,000 is the value of inventory. Right? Inventory is 1 lakh 50,000. So stock is basically what we computed right now over here. 1 lakh 50,000. Stock is 1 lakh 50,000. Now, next, we have used this ratio, by the way. Inventory and cost of goods sold is also used. Now, coming to the next part, which is this current ratio. See, current ratio is given as 2 times, right? So the current ratio is 2. So we know it is current asset upon current liability. Now in current assets, we have stock, we have receivables, we have cash divided by, in current liability, we just have the payables. This is 2 equal to stock of 1 lakh 50 plus receivable of 2 lakh plus cash upon payables is 2 lakh. So you can just solve it as 4 lakh is equal to 3 lakh 50,000 plus cash. So basically you'll have a cash of 50,000. So here we get this cash balance of 50,000. Done. We have used this current ratio also. Now, interest on debentures is given as 60,000. Right? Interest on debentures is 60,000. And connected with that, do we have any other ratio? No, right? We don't have any ratio as such. We just have the return on net worth as 25%. Income tax is 50%. So let's try to prepare using this sales and cost of goods sold and then operating expenses. So statement, or I can say sales is 60 lakh. From that, you deduct your COGS which is 18 lakhs. Right? So from 60 lakh sales, you deduct the 18 lakh COGS. Then you have a GP. And that GP is essentially 42 lakhs. The question says that the net profit to sales ratio is 6.25%. Net profit to sales ratio is 6.25%. So net profit is equal to 60 lakh into 6.25%. 60 into 6.25%. So that's like 3,75,000. Right? So the gap between GP and NP is essentially going to be what? What is it going to be? What are you saying, guys? Interest is 15%. Yeah, true. We can compute that 15% debentures with that. Now, the net profit is 3,75,000. So we need to work out the other part. You know, from the GP, you essentially compute less operating expense, right? And then you get the profit before tax. From that, you reduce the tax. What's the tax rate? Tax rate is at 50%. So if income tax is 50%, net profit, if your PBT is 100%, tax will be 50 and net profit will be also 50. If you do the reverse calculation, 3,75,000 over here. Here it is 3,75,000. So PBT should be ideally 7,50,000. So operating expense will be a balancing figure 42 lakh minus 7,50,000, which is 34 lakh 50,000. So this is operating expense is 3,50,000. If you say that it's 3,50,000, that's essentially not correct by the way, guys, because from this operating expense, I actually still need to consider some other effects also. What is that other effects? See, from this operating expense, we need to subtract, we will actually get after deducting this as EBIT. And then from EBIT, you deduct the interest, you get PBT, right? So GP from that operating expense, and then interest, and then EBIT. So how do we compute this interest, by the way? Well, the interest can be computed, or rather interest is given as 60,000, right? Right, interest is given as 60,000. So doing the backward calculation, your EBIT will work out to be 8,10,000. And then your operating expense will be a balancing figure, which is 42 lakh minus 8,10,000, which is 33 lakh 90,000. Yeah. Correct, guys? 33 lakh 90,000 operating expense. Just verify over here. Yeah, you can see 33 lakh 90,000. So operating expense is 33 lakh 90,000, which we have computed by reverse calculation. Okay, but I still need to fill up this portion, and for that, I need the amount of debentures. So debentures will be interest upon interest rate. What's the amount of interest? It was 60,000. What are the interest rates? That was 15%. So 60,000 divided by 15%, that's 4 lakh. The debenture is 4 lakh. 15% debentures is 4 lakh. Right? We have interest on debentures is also done. Debenture is also computed. Net profit to sales ratio is also used. We have used the return on income tax also. Now coming to return on net worth, 25%. So we need to look at that ratio now. Return on net worth is 25%. Now return on net worth, if it's 25%, that's actually net profit upon net worth into 100. The 25 is equal to net profit is we have computed 3,75,000, right? So 3,75,000 upon a net worth. So this works out to be 3,75,000 divided by 0.35. So net worth, we are getting it as 15 lakh. Now net worth is actually combination of both share capital as well as reserves. Darshan is asking, sir, net profit given is always PAT. Yes, Darshan, net profit, whenever they say it always means the PAT. Now we have this ratio of share capital to reserves. So we understand that net worth of 15 lakh is equal to equity share capital plus reserves. But then this equity share capital and reserves are having a ratio of 7:3. This 15 lakh needs to be distributed in the ratio of 7:3. So if you break that into 7:3, so 15 divided by 10, which is 10 lakh 50,000, and the balance 4 lakh 50,000 is the reserves. So equity share capital and reserves. The equity share capital is 10 lakh 50 and reserve is 4 lakh 50. Okay, so now the only thing balance left out is fixed assets, so that we can compute it as a balancing figure. You can simply take a total over here, 10 lakh 50 plus 4 lakh 50, 15, 15 plus this 6 of 21 lakh. Now from that 21 lakh, you need to subtract 1 lakh 50,000 minus 2 lakh minus 15,000. So probably 17 lakh worth of fixed assets should be there. Right? Is it right? Just verify from the solution. Yeah. Net worth. Net worth is net worth is the owned funds, right? The equity share capital and reserves. So you have the return on net worth. So 25% is the return on net worth. So 3,75,000 is your net profit, which we have computed earlier. That 3,75,000 is used to obtain the net worth amount. Right? 25%. Okay, that's cool down to one. Shubham. Cool down. 25%, 25, it's just one and the same. If you don't like this, you can take this as 0.25 by removing this 100 also. It's just a normal calculation. Himanshu is asking which ratio, how to remember which ratio is number of times or percentage or simple ratio. All your return ratios, Himanshu, they are always in percentage, right? Because you always ask what is a percentage return that you offer to give. So all your return ratios are always in percentages. Profitability ratios are always in percentages. all your activity ratios are always in number of times, right? And the simple ratios are the other ones like the current ratio, liquid ratio. All those things are the simple ratios, debt equity, right? So again, I can simply give you some sort of a general view, and the general view is like these are going to be normal ratios. These are also going to be normal ratios. This is going to be in times, and profitabilities are always going to be in terms of percentage. Return on net worth, Darshan, numerator is your profit after tax. When you say net profit, that's going to be the profit after tax or net profit for equity shareholders. That's going to be the numerator. Is it clear? Are we good with this question, guys? Are we good with this question? Shall we go for the next one? Shall we go for the next question? I think we're all good. So we can go for the next question. Understood? Yes, yes, yes. Okay. Let's go for question number. Let's look for this question 9. We anyways have a revision class of this ratio analysis chapter. So there we'll be doing some more questions for practice also. Okay. So right now, let me take up this question number 9 from the study material. Okay. From the following information of Temer Limited, we have the debtor's velocity as 3 months. Understand this debtor's velocity is nothing great for, but it is just the debtor's collection period. Creditor's velocity is nothing but creditor's payment period. Stock turnover ratio is given, gross profit ratio is given, bills receivable is given, bills payable amount is given, gross profit is given, fixed asset turnover is also given as 4. Closing stock of the period is 10,000 above the opening stock. So closing stock is 10,000 higher than the opening stock, and we are supposed to determine the sales, cost of goods sold, sundry debtors, sundry creditors, closing stock, fixed assets. Okay. Now for this, we have we have to compute all of them. Now let's first talk of any ratio that you can think of to be beginning with. Debtors velocity is 3 months, creditors velocity is also 2 months. Stock turnover is also given. We don't have any stock information, but we do have a GP, and we have a fixed asset turnover of 4. Now, the only things which you need to understand that these two are getting connected. Gross profit ratio of 25 and GP of 4 lakh. So that's your starting point for the question. And that's from where our solution should begin with ideally. Is given, profit is given, GP ratio is given, and gross profit is given. So we need to compute the sale value also, right? So sales, we can compute using this ratio. So we know GP ratio is gross profit upon sales into 100. So GP ratio is 25 is equal to 4 lakh divided by sales into 100. So sales will be, that's going to be 4 lakh divided by 0.25, which is 16 lakhs. So we have this sales as 16 lakh. And then from this, if you subtract the GP, which is 25%, that's like 4 lakh. And then you have the COGS as 12 lakh. Right? So COGS is 12 lakh. Now using COGS, which ratio can I really use for computation purpose? Related to COGS, we have the stock turnover from sales. We can take the debtors velocity also, right? So let's go ahead with the sales is done. COGS is also done, guys. That's also pretty easy. Now what we want is the sundry debtors, sundry creditors, and the closing stock. Okay. So let's talk of sundry debtors. Now we have the debtors velocity as 3 months. Now, of course, here we are assuming that all the sales are on credit basis. So debtors velocity is same as debtor collection period. And we know that debtors collection period, since it is 2 months, we would have taken, like the calculation would have been 12 divided by debtors turnover. Debtors velocity is 12 divided by debtors turnover, which is simply 12 divided by debtors turnover is what? Sales upon average debtors. So which is 12 divided by sales is 16 lakh, right? And we have the average debtors, and this debtors velocity is 3 months. Debtors velocity is 3 months. So now remember, when we are using this debtors turnover, some problem. Yeah. So when you're looking at the debtors velocity, as I said, it's the just the debtors collection period. Now, in the debtors turnover, I have told you that it is sales upon not just the average debtors, but rather this debtors include actually debtors plus the bills receivable. Okay. So instead of saying debtors, we actually call it as average receivables. So average receivables. And by solving this, we can simply say that average receivables is equal to, it's going to be 16 lakh into 3 by 12. So 16 into 3 by 12, that's 4 lakh. Now this average receivables is actually debtors plus bills receivable of 4 lakh. So what will be the amount of debtors, amount of sundry debtors will be 4 lakh minus 25,000, which is 3 lakh 75,000. This is the amount of sundry debtors, right? Now, similarly, we have to look for the sundry creditors part. For that, we'll have to use the creditors velocity. We have sundry debtors as 3,75,000. Now, after this debtors velocity, let's look at the next part, which is creditors velocity. Or this is the creditors payment period or receivables thing. So this is 12 months divided by receivables turnover. Now that actually works out as 12 divided by receivables turnover will be based on purchases. Correct? Will be based on purchases. So this is going to be like 12 divided by credit purchases, the whole divided by average accounts receivable, right? And this is given to be like, oh, how much? This is like 2 months, right? Yeah. So 12 divided by credit purchases upon average accounts receivable. I need to compute this credit purchases. How are we going to compute this credit purchases? We know COGS is opening plus purchases less closing. So what is the COGS amount? Cost of goods sold. We have computed it, right? So cost of goods sold was 12 lakh, which is like 12 lakh is equal to opening stock of material and closing stock of material. We have closing stock of the period is 10,000 above the opening stock. So closing stock is 10,000 above the opening. So essentially what I can say here is this figure, opening minus closing. I can simply write it as a, since the question says closing is 10,000 above, so opening minus closing is going to be minus 10,000. We have the purchases of 12 lakh 10,000, correct? Now we can take that purchases in the next part, which is 12 lakh 10,000 credit purchases divided by average accounts receivable, which is 2. So we get average accounts receivable as 12 lakh into 2 by 12, which is 2 lakh. Is it? No, am I bad? It's 12 lakh 10,000, right? So 12 lakh 10,000 into 2 by 12. 201,667. 2,01,667 is the average accounts receivable. Now, of course, this average accounts receivable is a creditors plus bills payable. So creditors plus bills payable of 10,000 is 201,667, which means creditors is, oh, if you just subtract it, 1,91,667. This is the amount of sundry creditors. Sundry creditors. It's for accounts payable, right? Yeah. Fine. So we're done with the creditors part also. We have, say, sales done, sundry debtors done, sundry creditors done. Now closing stock and fixed assets. Okay, so for closing stock, we'll take help of the stock turnover ratio. For the closing stock, we'll have to take help of the stock turnover ratio. Let's go ahead. So we have the stock turnover ratio is given as 1.5. Now that 1.5 is actually, stock turnover, we use COGS divided by stock. Yeah, the closing stock is 1 point COGS upon average stock, which is essentially COGS we have computed already. COGS amount was 12 lakh, if I'm not wrong. Yeah, 12 lakh divided by, we want to know what is the average stock. So average stock is essentially 12 lakh divided by 1.5. And that's 8 lakh. Now we know average stock is opening stock plus closing stock divided by 2, which is equal to 8 lakh. So now if you take opening stock as X, that closing stock is X plus 10,000, because your closing stock is 10,000 above the opening stock. So divided by 2 is 8 lakh. And therefore, this becomes like 2X plus 10,000 by 2 is 8 lakh. Then we have 2X plus 10,000 is 16 lakhs. And finally, we can say 2X is now 15 lakh 90,000, right? And then X you have it as 15 lakh 90 divided by 2, which is 7 lakh 95,000. Now this 7 lakh 95,000 is your opening stock. You have opening stock as 7 lakh 95,000. So essentially closing stock is 10,000 above this. So your closing stock is 7 lakh 95,000 plus 10,000, which is 8 lakh, sorry, 8 lakh 5,000. Yeah. Essentially 8 lakh 5,000 is the amount of closing stock, right? So I think the fourth part is also done. Closing stock is also done. Yes. Then fixed asset. Now fixed asset, for that we have to use the fixed asset turnover, which is 4 times, right? So fixed asset turnover, is it given whether it is on sales or on COGS? Nothing is been specified. So essentially we'll do one thing, we'll do both the ways. In exams, if you have such scenario, try to solve it both the ways and give both the options study. Okay. So they're using the fixed assets turnover ratio. Now fixed assets turnover ratio is sales upon fixed asset or COGS upon fixed asset. If I use the first option, fixed asset turnover ratio is given as 4. So 4 is equal to sales upon fixed asset, right? So we have 4 is equal to sales is 12 lakh upon fixed asset. And therefore, fixed asset is 12 lakh divided by 4, which is No, it's not sales. What was the sales? Sales wasn't 12 lakh. Or suppose sales was 16 lakh. Okay. So that's 4 lakh, right? And if you go for the second option, wherein you are using COGS, then you say that 4 is equal to COGS upon fixed asset. So that's essentially 4 equal to 12 lakh divided by fixed asset, and fixed asset in that scenario, it's going to be 3 lakh. Okay, so fixed asset is 3 lakh. So I think we've done all the numbers for this question. Yes, we have done all the numbers. We've done a couple of questions for practice from this study material itself. You can go through the other questions also similarly, try to solve them. If there are any issues with those study material questions, you can definitely uh, come back to me on the revision lecture. And in that revision class, we'll be doing questions from the past RTP. Okay, from the past RTP or from the MTP or the past question papers that will do it. Okay, so let me see if there are any queries. For inventory turnover alone, we should take COGS, and for other turnover ratios, sales should be used. Yeah, true, correct. Darshan, you should be using, and for inventory, it has to be COGS. And for other turnover ratios, it should be sales. So Mr. Ustad Singh is asking, which application do you use, sir? Well, this is a app on iPad, which is known as Flexil. Okay. Any other queries? There isn't any. Okay. So you can go through this remaining questions from the study material. I have done a couple of questions for you. Rather, we have done 3 questions. Always remember some trick for solving it. Whenever the question comes up to you, try to connect with a ratio with a typical number that we have on the question. Like over here, we have GP and the gross profit ratio. We connected both and then proceeded with it. Similarly, if you look at this question 7 also, look at this. There's current ratio, debt equity, return on assets, all these numbers ratios are there. Try to connect a ratio with a pre-stated number. The current ratio is like 2.5 is to 1. Do we have any number which is connected with this ratio? Yeah. Look at this, net working capital. So here you can say this is current asset upon current liability, and this is current asset minus current liability. Connect these two and then proceed with the question. So connect these two, that is current ratio, and then you can take it forward with the next step. Okay. So always try to open up the question in the similar lines. Whenever you find that you're stuck somewhere, just do one thing, prepare a balance sheet, note down the fixed assets, note down the current assets, note down the equity, share capital, everything, and then try to balance sheet and try to balance it. Okay. Okay, so Ustad Singh is like, I'm curious about its performance. Yes, it's really good app. It has got multiple utility. Ivanshu is asking, the concept of capital gearing is clear, but the formula depicts the capital gearing. How the formula depicts the capital gearing? Well, Himanshu, if you look at the capital gearing, it's like, risky funds upon non-risky funds. Look at this. The formula is like borrowed funds plus preference share capital upon equity shareholders fund. These are the risky funds, right? The borrowed funds and the preference share capital. That's the risky funds because you need to pay a fixed rate of return to them. Whereas the denominator is not a risky fund. Denominator is something, they are buying your shares with that's not risky for the company, by the way. Okay. For the company, these are a risky source of funds because you need to pay, or you're required to pay a fixed rate of return to them, or fixed rate of interest or dividend to them. Otherwise, they will, file a suit against you for liquidation and all things. And then you have this equity shareholders fund in the denominator, which is on which you need not pay any fixed return. So this is like funds which require fixed return in the numerator and funds which do not require fixed return in the denominator. Right. So it's like a ratio of fixed return fund and non-fixed return fund. And that ratio is what we mean by the capital gearing. Now, higher the component of fixed return, it means you're taking more gearing. You're taking funds which require only fixed return with an expectation that we will generate more return than those fixed return funds. Okay. So I don't think any other queries, guys. No, I don't think any other queries as of now. So we'll meet up sometime later with a new chapter. Till that time, I would request you all guys to practice the questions from the study material. All the remaining questions, do practice them all. And if you face any difficulty, please come forward to me in the next session of our revision class. Okay, so with that, I think it's time to call it a day. So let's just stop here for the day, guys. See you in the next class. Good night and take care. I will definitely upload this on the portal. Good night, guys. All the best. Take care. Bye-bye.